The reason why most people have a hard time making money in crypto is the massive volatility. Prices go up and down. It's very hard to time this right. Now maybe there's an approach to time this slightly better. So let's say we've got our Solana price over here and it goes up and it goes down and it has these massive runs. A drop like this in Solana can be easily more than 90%. Thus, when we recover from a bear market, we can easily have a 10x return. And so the issue is, how can we be in the market during times like this and be out of the market during times like this? Now, there are several approaches. For example, I've talked about moving averages, right? Moving average simply just average out the price movements. They try to get rid of the daily volatility and they just try to capture the macro trends. So we are in the market when the price is going up, we then sell. Once the price goes below the moving average, we buy back in when the price goes above the moving average. The issue is, what is the best moving average? Is it the 100-day? Is it the 200-day? How many days should we actually average out? If we go closer with our moving average duration, right? We are more short-term in our moving average duration, then we tend to react quicker. So we sell earlier and we buy earlier. That's great. But the issue is we might also have our bad signals. The daily volatility can sometimes kick us out, and that can also be pretty costly. So there is a balance to be made here, right? We can't take the 3-day moving average. We cannot take the 300-day moving average. But that's where simulations come into play. Simulations of buying and selling Solana based on historical data. And what we see here, that's the result of 364 backtests. So on the x-axis, we've got the moving average duration. On the y-axis, we've got the annualized performance. And historically, it was the 63-day simple moving average that worked the best for Solana. It gave a 180% annual return versus buying and holding only 113%. This is then how that looks like over time. We buy whenever we are above the moving average and we sell, so we are 100% in cash when we are below the moving average. That's why the portfolio line here in blue goes flat every now and then. And so you can see the outperformance does not come because we make more money in a bull market. It comes from not being that often invested during bearish times. So 36-day, that's the magical number. And here is the Solana price with that moving average. So does it make sense to buy right now, or does it make sense to rather wait? Where is the potential threshold in terms of price? We see it over here. We are still below the moving average. The level is currently at $101. Now this is one of many approaches, but we can also do it slightly differently. So instead of buying and selling based on the price relative to the moving average, we could also make the argument that maybe it makes sense to buy when the short-term moving average crosses the long-term moving average. So we're not looking at the price at all. We are just looking at two moving averages relative to each other. So this is how that could look like on a chart. We've got a shorter term moving average. So that's the red line over here as an example. And we've got the longer term moving average. Let's take away the price from the chart. We would be long. We would be betting on rising prices whenever the short term moving average is above the long-term moving average, and we bet on falling prices when we are below. So this way we completely ignore the daily ups and downs. We're just trying to find out where the current trend is. Now with this approach, finding the optimum is a bit more difficult, because before we just optimized one moving average, right? We try to find the best duration versus the price. But if we now have two moving averages, the question is, what pair works the best? What two moving averages work the best historically, and how well does this approach in general work? Have a look at this here. This is a matrix showing on the one side the fast moving average period, and on the other side the slow moving average period. And each dot here, each square, it represents the performance. When it's dark green, it's very positive. When it's dark red, it's not so positive. So we can tell this here is probably the best moving average. So what is that pair? It's the 14-day for the fast moving average and the 31-day for the slow moving average. Now this gives us much better return, 287% per annum, versus the prior optimum single moving average being only at 180%. So this approach clearly beats just simple moving average crosses. And by the way, what you've seen over here, that is already the best moving averages. That's historically what worked the best. It's the 14-day and the 31-day, the 14-day being the one in red and the 31-day being the one in turquoise. How does this performance work over time? So again, we've got our Solana price together with the two moving averages. We've got our portfolio line here in blue, and we can see how measured in Solana we tend to either go sideways or we go up. There are some periods though of 1 to 1.5 years where we do not outperform Solana. There are only certain periods where we then outperform quite a bit. This here is also a logarithmic scale. Again, the outperformance is quite massive. It's almost a 3x every single year since Solana's existence. Now we can take this a step further. Right now we're just buying Solana when we get the buy signal, and then we sell Solana, we get into cash whenever we get the sell signal. But we could also bet on falling prices. So when the price of Solana suddenly crashes, we now make some money with that. So we are moving our exposure from long plus cash to long plus short. And this is then how our portfolio line looks. This is with shorting, this is without shorting. So with shorting, we get extra performance. Now we are looking at an annualized return of more than 5x or 400% every single year. The maximum drawdown of this strategy is 80% versus buying and holding. We had at some point a drawdown in Solana of 96%. So we increase our return and we reduce our risk by having 66 trades during Solana's lifetime. Now those are all just simulations, right? Nobody knows if the same approach will still work in the future. But in general, I like to just figure out what kind of trading rules tended to work in the past. They don't necessarily have to work in the future, but it's better than just random guessing. It's better than just following the news. I like to follow market structure. And very often, even though history might not repeat itself, it often rhymes still. That's how I approach the market. Now you might have already seen here, we've also got settings for long and short leverage. So we can lever this up now. If you're not happy with 400% return, let's optimize our leverage. Let's try to figure out what the best leverage actually is. Solana is already extremely volatile. So on the long side, we can only go 1.5x. On the short side, we can go 1.75x. If we do that, then we make an annualized return of 558%. At least that's historically what would have happened. But also we increase our risk. This strategy now has a maximum drawdown of 95.7%. Very comparable to buying and holding Solana. So now we've got a setup where we do not reduce our risk anymore. We only increase our return. If we want to have more return and less risk, we better do not use any leverage. But if you want to maximize our return, then we should add a little bit of leverage. And 1.5x is the best. 1.75x though gets us liquidated on the long side. On the short side, a 3x will get us liquidated. So here's the performance going long and cash just on the spot market, no leverage. Here is the performance long and short without leverage. And once we introduce leverage, that's our performance. Just have a look at this return chart and have a look at how this is valued in Solana over time. And this here, that's the big drop that the price itself also experienced. And so yeah, when we compare those two approaches, right, the direct price cross versus the moving average, it still doesn't look like this is a buying opportunity. But when we look at the superior approach, the one that doesn't use price crosses, but the one that uses optimal golden crosses and death crosses, we have just seen a golden cross. The golden cross happened over here below $85, and the momentum seems to be turning around. And again, the trends in Solana are quite significant. A positive move can easily bring 33%. And when we then lever this up with 1.5x, that's a 50% gain. And so I'm considering to long Solana to find especially relative valuation trades on Solana. So tokens that tend to be underperforming Solana. So we go long Solana and we go short a poor altcoin. Many altcoins tend to underperform Bitcoin, Ethereum and Solana over time. So especially when those hedges, right, when the major cryptocurrencies are bullish, it does make sense to look for short opportunities of the altcoins that usually don't go up as much as the major cryptocurrencies. So that's my plan. I will of course share my individual trades in premium as well. The tool that you've seen over here, that's also accessible for the premium members. It's currently in development, so there will be more improvements. But right now it already has quite a few tricks up its sleeve. There are some indicators that you might have never heard of before that can be backtested. There are some assets that can be backtested. Both of those will be expanded over the next days. And there are different modes, right? A simple backtest, finding out what the best moving average is, finding out the best combination of two indicators. This doesn't have to be moving averages, right? This can be other indicators as well. And then of course, optimizing the leverage as well. But this will extend, this will be richer in features and also easier in its usage in the future. This is the worst it will ever be, and it's already extremely useful. Thanks for watching. If you got some value out of this, feel free to give it a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly over here. See you next time on YouTube or see you in premium. Cheers.